Well, looking at South Africa's largest consumer goods maker, Tiger Brands, it posted an 11% increase in full-year profit today. Daniel Isaacs from 361 Asset Management joins us on the line now to dissect the numbers further. Daniel, good to have you with us. Clearly, everything that grabbed the headlines today has to do with that Nigerian write-off. Many people saying it's understandable given the concerns that were raised by Peter McClary just over a year ago.
Yes, that's true. Look, quite a significant write-off during the year. I think that when the business undertook the acquisition, there was some concern about the price paid at the time. That has proven to be a correct concern. The position there being not as easygoing as perhaps what might have been expected to start with. So yes, the write-off I think pretty much expected going into this year.
Daniel, Mark here. For those watching this program looking to put money to work, we've seen the Tiger price quite buoyant in the last fortnight or so. The PE is around about 20, the dividend yield gross is about 2.5%, about 2% net of dividend tax. What's your sense, Daniel, if you're looking to deploy fresh money?
Look, it's had an unbelievable run this year. I mean, coming into the year when it was still in the mid-200s, it was looking like it was offering some value because the price at that time was discounting a more negative picture than was actually the reality. However, now after this run, I think you've got quite a bit of the future potential priced in. So if you're currently looking to deploy money into the space, you're actually seeing similar price movements from the comparables, the likes of Pioneer, AVR. You know, the food defensibles have re-rated very strongly. So I'd say for now, this sector is probably one that you want to wait on the sidelines for the heat to cool off.
How long would you have to wait, especially if looking at a stock like Tiger Brands, a PE of just over 23? Does it make it a lot more expensive compared to its peers?
So currently it's probably trading more in line. All those guys are trading on pretty demanding P's at the moment. I think Pioneer is close to a 20. I'm talking forward P's. Pioneer is close to a 20. Tiger Brands probably closer to an 18. AVR closer to an 18. So you are looking at quite an expensive space at the moment.
Daniel, management have been doing some pretty useful work on the rest of the continent, and even then with DFM, there's been quite a lot of remedial work in the last year, with perhaps more to come and therefore declining losses. Overseas fund managers seem to favour this. Daniel, do you think this is a stock that could provide some useful upside surprises, shall we say, in the next 2, 3, 4 years if you are patient?
So what the business has outlined for the Dangote business is not to expect break-even before the year 2016. I think that the situation in Nigeria is quite difficult. I mean, you've seen this from the likes of Unilever, Nestle, some of them reporting revenue going backwards. So the economic climate in a lot of these African countries is quite a bit more difficult than I think a lot of people expect. So I'd say for now, you know, it's a bit safer to wait, like I mentioned before, for the pricing to cool off a bit before you price in a significant upside surprise from the African operations coming in the next 2 to 3 years.
Sit tight and wait. That's the message coming through from Daniel Isaacs. He's from 361 Asset Management.